In this presentation, we will continue on with our corporation comprehensive problem focusing in on journal entries related to dividends. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Information will be up top. We're going to enter that into the general journal, post it to the general ledger, and then create the trial balance from it. So we're going to have two things that are going to happen here, and we're going to say that they happen basically at the same time, but we want to show the two journal entries that will be involved with dividends typically. So we have the dividends declared and then the dividends that are going to be paid. So we're going to record those both as of this time period. Typically, if you're in a larger company, they're going to have two separate dates that this is going to happen in. And you can think of this, the reason this happens is first, what are dividends? Dividends are going to be similar to a draw for a sole proprietorship or partnership, meaning we would expect, hopefully what happens is the company makes money, and once the company makes money, then the owners are going to want to take the money out of the business for personal use at some point. That's the point of the business. For a sole proprietorship or partnership, that's usually done with a draw. We would draw money out of the business. With a corporation, however, the owners are called stockholders, and we have to basically make those draws, those money going from the business to the owners, be uniform in some way. And the way we do that is we say that if we're going to give money to the owners, it has to be all the same amount in proportion to the number of shares that are out there. And so once we declare there's going to be a dividend, we have to give the same amount of dividend to the owners that are out there, the shareholders that are out there. Now you can see that that's more of a bureaucratic process, so it's a little bit more difficult in some cases than to just draw out money because of this process. So we have to basically declare a dividend, and then we have to decide when the people are going to be receiving that money, meaning stocks can be sold. So the question is, at what point in time had someone have to be holding the stock in order to get paid the dividend? So we have to figure out what that point in time will be, so that we know who gets paid if stocks were exchanged in the interim. And then, of course, we have to actually pay the dividend at a future point in time. So the larger the organization, the more lag that process will take. So if we're talking about a large company, then there could be some distinctive lag between those three time periods. If we have a smaller company, then those things might happen pretty close together. We can declare a dividend and go through that process a little bit more quickly. So in essence, we're going to have these two journal entries here that actually have the journal entries. That middle date, determining who owns the stock, there's no journal entry involved in that, but we just have to know, we have to decide, okay, on what date are people holding these shares? Are they the ones that are going to get paid in case in case the shares are traded? That date doesn't involve a journal entry, but it does involve us knowing who to pay in terms of the owner of the stock. Okay, so first we declare the dividend. So our question then is cash affected. We're going to say, no, not at the date of declaration, because we haven't yet paid it. So what we're going to have instead, and usually I think about what we get, and you could think about, well, we got a we didn't really get any, we didn't buy anything. We got a dividend that's going to go out here. So this is one time when I might think of, well, what's going to be the other side of this? It's going to be some kind of payable. When we declare the dividend, in other words, we're saying we're committing to paying the shareholders money, but we haven't done so. So we've kind of told ourselves that there's a liability. We're owe something in the future because we've promised to give something, and that's going to be called dividends payable. So in this case, I would actually kind of start with the dividends payable, because that might be the easiest to think about and say, okay, the payable goes up. It's a liability. We're going to credit it because we've declared that we owe this money. And then the other side of it is going to it could either come out of retained earnings, if we're just going to record it to retained earnings, or it's going to come out, we can put it into an account called dividends. And the dividends being like draws, it's going to be a contra equity account, meaning it's going to be a debit balance account. So the journal entry looks like this. We're going to debit dividends, or sometimes you might see it just debiting retained earnings, and then we're going to credit dividends payable. Now, this is similar to, like I say, like a draw that comes out. What's really happening is we're paying the owner's money. So why does it work this way? Note where dividends is and where retained earnings are. They're in the equity section. So dividends is kind of like an expense. It's a contra equity account. You can think of it. It's a debit balance account, whereas equity accounts are credits, meaning if we look at all the equity accounts, credits will win. These are going to be debits, reducing the total equity, reducing how much the credits will win by. They're not on the income statement, however. They're not an expense type account on the income statement because they have nothing to do with the performance of the company in terms of how they did revenue minus expenses. It's just deciding how much money the owners want to take out of the company in terms of dividends. So this is the money that we're going to take out of earnings over time and give to the owner. That's why it could be posted directly to retained earnings representing how much has been accumulated over time that we're going to give to the owner. Now here, there's nothing in retained earnings. Why? Because it's our first, period of operation, first month of operation. But retained earnings is really $19,600 because this amount is going to roll into retained earnings once we close out the period. So really retained earnings is going to be all of these numbers because equity, remember, is all of this. This half of it represents how much is owed, how much was invested by the owners. This half down here represents basically what the company has earned over the time period less what has been distributed in the form of dividends. So that's what's happening here. We're going to debit the equity section, not affecting net income, reducing how much is owed to the owner because we're going to pay the owner. We haven't yet paid yet, so we haven't credited cash yet. We credited a payable representing the fact that we owe money, a liability account. And then what's going to happen is we're actually going to pay it at some future date. And so once we have this payable on the books, we're going to then pay it with cash. And so cash will go down and the payable will go down. So then we'll pay the cash and then we'll pay off the payable. So there's going to be a two-step process here. Now note, obviously, if this all happened on the same date, then really we can just debit dividends and credit cash and not go in and out of the payable here. But most of the time when we see this, we're going to see two transactions, two dates, and one's going to be the declared transaction where we have the payable but we haven't yet paid it, and then we're just going to pay it just as we would with any other kind of payable. So it would look like this if we're going to post this. We're going to post this out. We're looking for the dividends account in the equity section, the cash account, and the dividends payable. So if we go to our chart of accounts, here's the cash account. Here's the dividends payable, same order as the trial balance. And then we're looking for dividends in the equity section. We're going to zoom in on those accounts and see what happens in terms of posting. So here's the dividends. We're going to post that to the dividends GL. It's going to go from 0 up in the debit direction to 1,500. Then we have the dividends payable. It's going to go from 0 up in the credit direction, 1,500 to 1,500. And then we're going to decrease the dividends payable. Now we're going to pay it. And so we're going to decrease the dividends payable. It's just going to go right back out again. So 1,500, bringing this credit balance back down to 0, just like if we're paying off, an accounts payable. And then we're going to pay the cash. So here's the cash was at 37,600. It's going to go down by 1,500 to 36,100. So now we're going to reconstruct our trial balance with these new numbers. So if we look at our trial balance, this 36,100 in cash, yours is probably coming from here. You don't have to retype it in, but that's what's going to change in the trial balance. We're going to change cash to 36,100. The dividends payable note went, the dividends is over here. It went from 0 up and then back down. So there's really no change after these two journal entries. It goes back to 0. And then the dividends here is coming from here. There's that 1,500. You only have one, probably you don't need to put it there twice. But that 1,500 is here. So we're going to populate cash. Dividends payable didn't really change. And then the dividends. Then if we add up the debits minus the credits, it will equal 0. And we'll see that here and we'll be back in balance. So what happened here then, if we look at it, we're going to say, okay, dividends here. Now this is another one that's a little funny. It's kind of like expenses. And this is where the equity section gets a little funny. When we talk about the dividends account, we say, well, dividends went up because it went up in the debit direction. It's a debit balance account, but it brought down total equity. So again, you can think of dividends as expenses as kind of a contra equity account. In equity accounts, credits will win. The dividends go up because they're contra to a credit balance. They go up with a debit instead of going up with a credit. And so therefore, when dividends go up, they bring equity down. So that happened, and then at the end of the day, cash went down. So cash went down and equity went down. Again, it went in and out of the payable, but the payable, if you combine these two, nothing happened, right? The payable went up, the liability, and then the liability went down. So after these two journal entries, these equal out, and what actually happened, cash went down, assets went down, equity went down. No effect on net income, however, because the equity went down in the dividends or retained earnings in the equity section. No effect on net income because nothing happened in terms of performance of the company. All we did is take what was owed to the owner. Equity section represents kind of what's owed to the owner, all of this, and paid back the owner with some of it, just like we would if we owed someone else, like an accounts payable. And therefore the credit balance account, if we think of all these blue accounts as one account, that total credit balance is going down because we owe the owner less money because we paid the owner cash. So cash goes down, and total equity, how much of the assets of the company being claimed by the owner, goes down. There's less assets in the company, and therefore the amount that's being claimed by the owner owned by the company goes down. For more accounting information and accounting courses, visit our website at accountinginstruction.info.